You may have heard that the Roth IRA is the most tax efficient way in which you can invest, and it's not wrong. However, there are two 5-year Roth IRA rules when it comes to both conversions and earnings that you need to be aware of. The plan in the video today is to talk through each of these 5-year rules, but first we want to cover how exactly can dollars get into a Roth IRA. We then want to cover how these funds are distributed and the order in which they're distributed. We'll cover how the first rule works, which will apply to conversions, and we'll cover how the second rule works, which applies to earnings. And lastly, we'll go through 3 different case studies, which will show you exactly how these rules would apply to a real life situation. If we haven't met yet, my name is Cieniewicz. I'm a CFP professional from Hyperion Financial. The information we cover today is meant to be educational in nature only, and in no way is meant to be any type of investment or financial planning advice. Before we talk through each of the 5-year rules, let's first discuss how the actual dollars can get inside of a Roth IRA. In every Roth IRA, there are 3 types of dollars that are in there. The first one would be contributed dollars. Contributed dollars come from Roth contributions, and these contributions are made with after-tax dollars. They are subject both to an income limit, in which an individual cannot be making over a specific amount, and they're also subject to an annual contribution limit as well. Since contributions are made with after-tax dollars, they can also be removed at any time regardless of your age, tax-free and penalty-free. However, you do also need to make sure that you have earned income in order to get these contributions inside of a Roth IRA. They can't come from sources which are not considered earned income. The next way that you can get dollars into a Roth IRA comes from conversions. Converted dollars come from pre-tax accounts, such as a traditional IRA or traditional 401k. Unlike contributions, there's no requirement that you have earned income that year. There's no income limit which would preclude you from doing this. And there's also no annual cap on how much you're able to do in a given year. The catch is that you must pay the associated income taxes due in the year in which you do the conversion. Since pre-tax holdings have not been subject to the income tax yet, you have to pay them in the year in which you complete the conversion. You can either decide to withhold taxes and send those to the IRS from the conversion itself, meaning that the net amount going into the Roth IRA would be less than the gross distribution, or you can choose to pay the associated income tax due with another after-tax source that you may have. Of note, you may also be subject to state taxes depending on your state of residence. You want to make sure you check that before you implement any type of Roth conversion strategy. Assuming that you go about the conversion correctly, there's no 10% penalty that you would owe when you complete this conversion. The last way that dollars can get into a Roth IRA are from the investment earnings themselves. And this is really where the magic of a Roth IRA can work. It's one of the few vehicles that has tax-deferred growth, and these earnings can be withdrawn tax-free really for any reason, and you do not need to report those on your tax return. The only catch is that they are qualified withdrawals. We'll cover what a qualified withdrawal is in a little bit more detail here, but what we also want to talk through is how a distribution from a Roth IRA is considered with each of these contributions, conversions, and earnings. The IRS does provide guidelines for which dollars are considered first on a distribution, and you want to make sure that you're tracking, or the custodian is tracking, how each of these dollars are considered. The first dollars that are withdrawn would be contributed dollars. And again, from what we discussed earlier in the video, contributed dollars can be taken out tax and penalty free at any time, regardless of your age. The next dollars that would come out are converted dollars. Lastly, earned dollars would come out third. Being that you can't be penalized or taxed on contributed dollars that you would have made with your after-tax contributions, it's conversions and earnings that we need to consider the 5-year rules for. The first rule that we'll discuss applies to Roth conversions. Dollars that are converted from a pre-tax traditional account to a Roth IRA need to be held for a minimum of 5 years. In the event you do not meet the 5-year holding period of these converted dollars and you take a distribution of these converted dollars, you would be subject to a 10% penalty, assuming that an exception does not apply. If I decide to do a conversion in December of a given year, the clock would actually start in January of that year. So in theory, it's not necessarily a full 5 years that you may have to wait, but you want to make sure that you at least cover the full 5 tax years that would be required. The reason why this rule is in place is that the IRS does not want to incentivize individuals to do a Roth conversion and then follow it up with a distribution right away. If they were to do that from a pre-tax IRA, they would be subject to the 10% penalty in addition to the taxable income. By doing a Roth conversion and then not abiding by the 5-year rule, if the 10% penalty was not in place, it's a way that you can work yourself around the 10% penalty. This rule will apply to each subsequent conversion that you do. So if you do a conversion 1 year and follow it up with another conversion next year, each of those conversions would have their own 5-year clock. An important caveat, though, is that this rule only applies to individuals who are under the age of 59 and a half. Once you are over the age of 59 and a half, this rule no longer applies to you. If you've made a conversion 5 years prior to your 59 and a half birthday, what would end up happening is your window would still be in existence and the 5-year penalty would still be there. But once you reach age 59 and a half, you're able then to take out conversions penalty free. 2 other quick items that are worth mentioning. The first one being that this would apply to backdoor Roth contributions because technically they are not contributions, they are conversions. You make a non-deductible contribution to a pre-tax IRA and then convert it to a Roth IRA. So those dollars are not contributions, even though you may sometimes hear them called backdoor Roth IRA contributions. They are not, they are conversions. The second rule worth mentioning is that conversions are done in a calendar year, not a tax year. Keep in mind that you're able to make a contribution up until the April deadline the following year, which would otherwise close that tax year. You have to do conversions within the calendar year. You cannot extend them until April of the next year. The second rule is applicable for anybody, whether you are under or over the age of 59 and a half. For a Roth IRA to unleash its power and to have those tax-free earnings withdrawn on a qualified basis, you need to ultimately meet 2 rules. The first is that you must be over the age of 59 and a half. And the second is that you must have had this Roth IRA or any Roth IRA for at least 5 years. Similar to the first rule that we talked about, this 5-year rule also has the clock start on January 1st of that tax year. So if I open up an IRA later on that year, it will start the clock as if I opened it on January 1st that year. Why that matters is because if you haven't yet opened up a Roth IRA and are considering doing so, you're able to do it in April prior to the tax deadline and have that count for the last year and about a quarter. As soon as you have done this for one Roth IRA in your lifetime, you're in the clear. If you decide you want to open up a second Roth IRA and just strictly utilize that Roth IRA for conversions, if you've had one open prior for at least 5 years, you are in the clear. This matters for individuals who may have oversaved inside of a pre-tax account, such as a 401k at work, or have a sizable traditional IRA that they would like to lower some of the lifetime taxable liability on. If you've had a Roth IRA open for at least 5 years, this really doesn't apply to you. But if you're planning on utilizing a Roth conversion strategy and haven't yet opened up a Roth IRA, you may want to consider taking action in order to get the clock started. One other thing worth noting is that a Roth 401k does not count. It needs to be a Roth IRA that is opened in order for this to count. Inherited Roth IRAs also follow these rules as well. If I inherit a Roth IRA from my father and he only had it opened for 1 year, there would be 4 years that need to pass before I would be able to utilize those earnings tax-free. Let's take a look at 3 different examples here to give you a better idea of how this would work in practice. The first one that we want to consider is Charles' improper planning. So let's quickly meet Charles. He's 58 years old and he has a December 7th birthday. He wants to start to do Roth conversion since he's oversaved inside of his pre-tax IRA. He opens his Roth IRA in December of 2024, right after his 58th birthday. He doesn't plan to do any contributions since he's a very high income earner. He immediately converts $20,000 from pre-tax to Roth. Charles pays the associated income tax that is due from his excess savings because he doesn't want to withhold it from his pre-tax account. The next December 7th, a year later, at his age 59, he does another Roth conversion of $20,000. He's earned $10,000 since he's opened the account, and he plans to take all of the funds from that Roth IRA in January to purchase a basketball court. Let's review the distribution schedule and talk through this. Contributions are what are distributed first, or distributed tax-free and penalty-free. But Charles didn't make any contributions, so we then go to his conversions. Since Charles is under the age of 59 and a half, the first 5-year rule would apply. Charles is subject to the 10% penalty on both of the conversions that he completed. That's because he's under the age of 59 and a half and he's not yet met the 5-year rule. He's also subject to taxable earnings as ordinary income and a 10% penalty on those earnings, being that he's under 59 and a half and has not yet held it for over 5 years. Unfortunately, Charles has made a pretty sizable mistake since he hasn't qualified for either of the 5-year rules. Let's look at Irvin's plan. So Irvin has had a Roth IRA established since the Roth IRA was first introduced in 1998. So he's covered the second 5-year rule. He was born on the same day as Charles, December 7th, and he's also age 58. He's contributed $60,000 over the years, and the account has done very well. It's earned $300,000. He now wants to do Roth conversions, however, since he watched a great YouTube video explaining how Roth conversions work. He decides to go small and does a $10,000 Roth conversion. He pays the tax due from his excess savings on his age 58 birthday. An opportunity arises that January that he can purchase a baseball team, but he needs $61,000 from his Roth IRA to do so. So he takes a $61,000 distribution from the account. Let's actually unwind this. So Irvin is able to take out contributions tax and penalty free. If we look at his history, he's contributed $60,000 over the years. So $60,000 can be removed, no questions asked. However, Irvin's move isn't 100% magical. Since the converted dollars are what are removed next, he's subject to a 10% penalty on the excess $1,000 above his contributions, because we look at conversions next. He's under the age of 59 and a half and hasn't met the first 5-year rule. Let's meet Larry Legend. Larry, much like his counterparts Charles and Irvin, is trying to come up with a smart tax plan. He's had a Roth IRA open for 20 plus years, and he has $50,000 of contributions, and he's made over $500,000 in earnings. He's also age 58 with a December 7th birthday. He decides to do a Roth conversion on his 58th birthday of $100,000, and he utilizes his excess savings to pay the associated income taxes due. He's planning to build a museum in honor of his late friend Bill. To do that, Larry needs $450,000 from his Roth to fund the project. Larry plans to fund the project on his 59th and a half birthday exactly and takes the distribution then. Larry, in this case, is in the clear. He's satisfied both the rules. He's over age 59 and a half, so he's no longer subject to the conversion rule. And he's had the account open for 20 plus years, so the 5-year rule of the earnings is not applicable to him. Larry's move is tax-free. He's utilizing his Roth for the best purposes. Ultimately, the takeaway that I think you should be considering is you want to make sure that if Roth conversions or if Roth contributions are part of your strategy, that you make sure that before you go ahead and do distributions from your Roth, that each of these 5-year rules are accounted for. By making sure that you've done your due diligence on both of these rules, you can unlock the real power of the Roth IRA, which is the tax-deferred growth and the tax-free withdrawals that are qualified. Assuming you do that, the Roth IRA is one of the best places in which you can save, grow, and then distribute your funds. Starting the clock early may work in your benefit, so consider doing so if you haven't done yet. My team and I at Hyperion Financial come up with strategies, whether it comes down to Roth planning or planning for retirement in general. If you haven't done so yet, subscribing to this channel, commenting, and liking this will really help get this out to more people. Feel free to also check out our website, HyperionFP.com, where you can learn more about us and our services and how we help people come up with long-term strategies to help with taxes, investment, and income planning.